60 rules in 20 minutes. For this video, we picked all of the most important investing rules mentioned by famous investors like Warren Buffett, Charlie Munger, Peter Lynch, John Tempelton, Howard Marks, Ray Dalio, and others. We extract the most commonly overlapping ones and explain them in the simplest words. Welcome to our Ready for Mars channel, where we can find other big ideas and helpful tips about personal finance, development, and health. The list of rules we'll be discussing is only a small part of the journey to becoming rich. We encourage you to start from more general videos about wealth generation first. You should feel confident and certain that picking stocks is for you. Be careful and be honest with yourself, because it's not the best course for most people. Always remember that there is a real possibility of losing real money. Rule number 1. Inflation. Always keep the rates of inflation and taxation in mind. Search for real returns. Gains that don't cover the rates of both inflation and taxes are not real gains. For some time now, having a lot of money in bonds has been bad because the returns don't cover the costs of taxes and inflation. Besides that, inflation influences asset prices. Inflation is your greatest competitor. Rule number 2. Casino. A stock exchange is not a casino, so don't treat it like one. Don't gamble. Aim for fewer transactions and avoid short selling, options, futures, and leverage investing. If you gamble long enough, you will lose eventually. Remember, the house always wins in the end. Rule number 3. Reality. A stock represents a piece of ownership of a company. It's not a lottery ticket. There are cash flows, people, leaders, brands, and assets behind it. It's real. If the company does well, the stock eventually does well. But if the company does poorly, the stock also eventually does poorly. Rule number 4. Flexibility. Be flexible and open. Different assets play the best in different times. Don't stick to any of them without good reason. There are no safe havens. Markets and businesses are dynamic by nature, so you must be the same. Avoid bias. Stay open to investing in different countries, asset classes, company sizes, asset proportions, etc. Nothing is fixed. Flow with the market's change. Rule number 5. Sell off. Buy at sell-off moments, which are moments when the masses of investors are selling off their shares of valuable stock and driving its price down. Sell when the experts and the public are optimistic, and buy when they are frightened. Occasions when investors irrationally sell off stocks enough to create significant buying opportunities are rare, so make the most of them. Rule number 6. Courage. Once you spot an opportunity you feel confident in, grab as much as you can. There are moments when greed is good. Show conviction and decisiveness when opportunities come. Rule number 7. Quality. Buy only good quality stocks. Buy market leaders, which are companies with good financial conditions, recognizable brands, and great leadership. Why have investments that are just good when you can have ones that are great? Rule number 8. Value. You must understand the intrinsic value of a company. You must understand where the value comes from, which threats may destroy the value, and which opportunities may strengthen it. Intrinsic value is more than just book value plus discounted cash flows. It covers soft aspects of the brand quality, management quality, ownership quality, and many others. The highest level of quality is the company that has an infinite moat. Rule number 9. Price. Price is what you pay, while value is what you get. You must understand this essential difference. You are the one that should truly determine the value. It's better to buy a great company at a fair price than it is to buy a fair company at a great price. Rule number 10. Profits. Buy companies that prove they can consistently generate operating profits. The stock can grow for a really long time after you first spot profits. There's no need to risk assets that only promise profits but don't deliver them. There are plenty of stocks that have proven they can produce operating values yet still trade under their real value. Rule number 11. Discount. Pay less than the intrinsic value. You must have a safety gap. This is called margin of safety. Rule number 12. Macro. Don't bother with macroeconomics. Don't base your investing decisions on the macro. The greater economy machinery is simply too complicated for anyone to consistently guess correctly. Nobody can consistently predict the macro, although doing so might look easy. Rule number 13. Future. The future is uncertain. Nobody can predict it. Things that have happened seem obvious only in hindsight. The future can go in different and unexpected directions even when things seem certain and fixed. The past does not dictate the future. Rule number 14. Forecast. Forecasts are nothing more than a forecaster's opinion. They tell you nothing certain about the future. You will always find contrarian forecasters with contradictory forecasts. So how can you accurately guess which one will be better? Rule number 15. Probability. Investment is all about probability. Nothing is certain. You will surely not succeed all of your bets, but that's fine. The truly important thing is to gain more than you lose. Rule number 16. Little diverse. Diversification is good, but it can be taken too far. 5 to 15 positions are fine. More than 15 positions do not bring any more safety. Having that many positions only brings management complications. You simply won't be able to keep up on so many holdings. Be invested in different countries, industries, and asset classes. But even this virtue can be a vice if taken too far. Rule number 17. Devotion. If you decide to be an active investor, you must find the time to follow your investments, search for new opportunities, check the news, and read reports. You must have basic understanding how your investments are doing over time and what the market condition around them are. Rule number 18. Learn. Understand your investing mistakes and successes. Study them critically. For many cases, just pure luck, good or bad, will stand behind your gains and losses. Accept your ignorance, because in most cases you will be at least partially mistaken. Whether you win or lose, strive to learn from it. Rule number 19. Style. Be humble. The vast majority of common investors do not beat the market. Even most of professionals don't do it. Consider passive ETF investing if you can't find any investing edge or enough time to devote to research. You must consciously choose your investing style, passive or active, and stick to it. Rule number 20. Timing. Spending time in the market is more important than timing the market. In other words, you will earn more by being invested consistently and surviving several drawdowns than you will by trying to time the best moment for jumping in. Rule number 21. Stomach. It's not your wisdom that will protect you from losses. It's your ability to withstand them mentally. Your stomach is more important than your head in investing. To be ready for moments of uncertainty, you must know the real intrinsic value of what you own. That knowledge will give you the confidence to stay in the game. Rule number 22. Excitement. Don't buy a company just because you like it. Leave your personal feelings aside. Invest in the company that has the best chance of winning, not the one that feels right to your emotions. Rule number 23. Temperament. Investing is about IQ as much as it is about attitude. You need to be stoic and emotionally disciplined. Feel no pleasure or pain from watching the market, crowd, or your investments. Study things with an objective eye. Rule number 24. No losses. Don't lose money. In practicality, that means don't lose too much money, because everyone loses a little sometimes. Cut your positions as fast as possible after the conditions for investment have changed. Remember that by losing 50%, you will need to gain 100% later on. Rule number 25. No precision. It's impossible to consistently predict hikes and dips in the market. It's better to be more or less right than it is to be precisely wrong. Rule number 26. Duration. It takes time for a business to grow. No matter how talented the people running it are, the company's growth can take a very long time. So don't waste the opportunity quitting in advance. The longer your investment perspective is, the safer you are, because average volatility drops over longer periods of time, keeping the uncertainty of hectic fluctuations to a minimum. On average, the stock market continues to grow in the long term, even if it occasionally shrinks in the short term. The companies you are trading in create the economy. This fact applies to growing economies as well as established economies. The ideal investment period for you is forever. Rule number 27. Quit. There is only one moment you can quit your position: when you find a better one. From this perspective, a temporary cash position might be the better one, but make sure it's the best position for all the possible ones out there. Rule number 28. Risk. Most investments require us to trade risk for gain. It's rare to find investments that don't adhere to that fundamental truth. Usually, the higher and faster the potential gains, the greater the risk. Your job is to not trade the risk for gain. Rule number 29. Rules. Knowing all the rules is simple. Understanding them is much harder. True mastery is knowing when to apply them. Rule number 30. Competence. When picking investments, you must stay within your circle of competence. You must understand what you buy and what external forces influence it. You must be able to explain each of your investments in a few sentences with high precision. Don't follow fancy topics that you don't understand. It doesn't matter how big your circle of knowledge is. It matters how well you define the borders. Rule number 31. Activity. The market transfers the money from active investors to patient investors. It's not only the fees that change the game, but also the ability of your investments to grow. Choose the right team. Rule number 32. Choice. Investing is the art of choosing better alternatives. Don't buy any asset unless you are sure that there are no better ones. But if you did buy one and found it wasn't good, don't wait to switch as fast as possible. Rule number 33. Patience. Don't quit your investment just because it's not growing as quickly as the market as a whole is growing. Stay in for as long as the fundamentals of your analysis are strong. Usually, your investment takes off the day after you leave it. Sometimes it takes a long time before the market reflects a company's success in its stock pricing, but it eventually always does. It pays to be patient. Rule number 34. Taxes. Using tax-free accounts like IRAs will boost your results in the long run. You will make double on a 40-year average investment period. Double. The same thing refers to brokerage fees. Rule number 35. Fluctuations. Asset price changes tell us only how much participants are willing to pay for assets, nothing more. It tells nothing about the fundamental change in an asset's value. Invest like you don't mind the market being closed for a year or two. You don't need to study every day's fluctuations. The value of a business doesn't change that frequently. Treat the market as a manic depressive trader who gives you a chance to buy cheaper than the value or sell more expensive than the value. Rule number 36. Business. Several key metrics make a good business. The most important of them are great people, great products, or great profitability. Altogether, they lead to a great moat, which is the holy grail of investing. Rule number 37. Compound. Take advantage of the most powerful investment tool in the universe, compound interest. You can do it yourself, or you can have the companies you are invested in do it for you. Great companies should remain profitable as long as they can compound profits faster than investors would do by themselves. Rule number 38. No idea. Investing is immediately saying no to 5% of the positions you consider, then saying, I don't know, to 90% of your considered positions, which should then effectively mean saying no. And only the remaining 5% of cases say, let's deep dive, which doesn't necessarily mean yes. It just means you will look deeper and seriously consider possibly buying. Investing is simply the art of careful and deliberate choice. Rule number 39. Owner. Once you invest in a stock, you become an owner. You must think like an owner. You are a business partner with the company you're invested in. You must understand your business, support it, and not leave it for a minor reason. Ideally, you should meet the management at the company's annual investor meeting. Rule number 40. Focus. Invest like you only have a few investing chances in your whole lifetime. Respect each of your choices. Think twice about each of them. Make decisions as if your whole life would depend on them. Think of how many people spend more time choosing new TV sets than they do choosing a stock. Rule number 41. Team. You are unable to scan thousands of stocks all over the world by yourself. It takes at least 1 hour to read a financial report and another one to make the basic research of that. You are lost if you remain alone. Observe others that work in the market. Follow proven investors, analysts, YouTubers, and peers. Simply anyone who can add value to your investing. Rule number 42. Winners. Keep your winning businesses as long as possible. Ideally, keep them infinitely. Get rid of your losing businesses once you're sure it's a loser. In other words, cut your losses and let your gains grow. Rule number 43. Steps. Buy a house first, as this will bring you an enormous level of self-confidence and will influence your approach to further investing processes. Invest only the amount you can lose without hurting your personal life. Choose asset classes and position sizes based on your knowledge and experience. Rule number 44. Forward. You must consider a company's prospects to be more important than its history. Don't drive your investment car by looking in the rearview mirror. You don't benefit from the past profits. You benefit from the future ones. Rule number 45. Learn. Absolutely, all famous business people read and learn on a massive scale. That is one of the rules common to absolutely all of them. This is simply investing on the highest return asset you know, yourself. Rule number 46. Leverage. Never, ever invest borrowed money. Such investments poison your view, shorten your investment perspective, and wears on you with unnecessary stresses and emotions. Rule number 47. Cash and gold. Cash and gold are not investments. They are stores of value and pretty poor ones. It's much better to have a productive assets instead. The only point in having cash is to be ready for bargains on productive assets. Cash and gold pay nothing, while cash additionally depreciates in time. Rule number 48. Shadow. The best investments stay uncovered, while the worst ones win applause. Avoid the hype, excitement, headline news, analyst top picks, etc. Search for boring topics that make you yawn. This is where the value often hides. Rule number 49. Simple. Keep it simple. Company financials, market situation, your investment strategy, all these you must be able to explain in a simple way. You must be able to make all basic calculations in your head. Otherwise, you haven't simplified the business idea enough. If you cannot do this, don't pick up the stocks. Just buy ETFs. Rule number 50. Win. You don't have to win on every investment. It's not even possible to do so. You are fine losing the majority of your investment picks so long as your total earnings exceed your losses. Investing is not a strike game. You may have to wait for the great swing. Rule number 51. Ignorance. Assume that you might be wrong on every single aspect of your investment knowledge. Try to understand how much you don't know. It's okay to not know as long as you are aware of not knowing. It's truly dangerous when you think you know more than you actually do. Rule number 52. Pessimism. Pessimism is your friend. You become wild when predatory pessimism spreads. Pessimism produces great prices. Rule number 53. Optimism. Optimism brings you into the danger zone. It looks easy to invest in happy times, but the truth is that it's the riskiest one. Good times require you to be doubly careful, not doubly optimistic. Rule number 54. Edge. Use only the edge you have. Invest in companies you know from your industry. Companies that make products you use and endorse. Frequently, you will notice great investments long before the experts do. It doesn't mean you must invest immediately, but you should definitely investigate the details of the potential find. Rule number 55. Pressure. You're not being forced to invest. You may spend a long time searching for great opportunities. Leave the money in the bank as long as you can't find any worthwhile investments. Rule number 56. Language. You must understand the language of finance, which is the language of accounting. You must understand the terms like balance sheet, profit and loss statement, and cash flow at the very least. Rule number 57. Limits. With no leverage, you can't lose more than you've invested, but the gains have no limits. Surprisingly, you can earn multiple times of invested capital. Dare for big gains. Rule number 58. Decline. Market drawdowns are normal, routine moments. You can call them part of business as usual. You must learn to act in opposition to majority. Rule number 59. Change. Everything changes. The companies you are invested in will change as time goes. If you don't understand them now, you won't be able to understand how they can potentially change in the future, and if you are going to profit from those future changes. So you must be able to anticipate them. Market conditions change, so companies you rejected one day may be interesting the next day. Rule number 60. You. The blank slate remaining here is you and your personal investing strategy. You must fill in this slate with your own rules, which you will learn from your own investing experience. We would love to hear your rules and add them to our list. Tell us about them in the comments section. You're welcome to become a part of our community. Thank you for your time. If you enjoyed this video, check out the more detailed ones we've made on each of these 60 rules individually. Get the full list in printable format from the link in the comments section below. Help us to grow this channel. Thank you.